Please welcome Rai from Nexus Mutual. You are sponsoring this conference, thanks a lot for that, and you will talk about blockchain native investment assets. Please take it away.
Hi everyone, my name's Ray, and I wanted to talk to you about the kind of investment assets that a decentralized insurance entity can have. So insurance companies do not live in a vacuum, and neither do DAOs/discretionary mutuals in our case. And I have to thank Matt because he introduced a lot of the concepts that I'll be talking about. So, first question, why do investment returns matter? So I've got here 5 of the what are known as dinosaurs, I believe. Crushed. And we've got the investment yield and operating profit here. And the investment yield, this is without gains, this is just the yield that they obtained on their assets. And you can see that in each case, it's higher than the operating profit, which basically means that if you don't get this investing right, then as an insurance company, you're not going to make any money. So we have to get this right, even in a decentralized world. So what kind of assets are fit for purpose? So from the insurance world, we have that the assets need to be low risk, they need to have a predictable return, and they need to be matched to the liabilities of the insurance, which means that most of the incumbents invest in exciting things like German government bonds. But the world of open finance also introduces some requirements. So we need assets that we can access without permission, which means that we could just take our tech and plug it in. It needs to be automated, so we don't want any trusted investment managers. We want to keep it low cost, and we want it to be unstoppable, which basically means that the assets have to be on chain. So over the next few slides, I'll talk about some of the early front runners that we're considering. And after Magda's disclaimers this morning, I feel I have to say I am not an investment advisor. None of this is investment advice. Please don't use it as such. So one of the most interesting ones at the moment is Ethereum is moving to a proof of stake protocol. So the long and short of it, without getting into too much detail, is you lock up 32 ETH in a staking contract, and you have an expected return in ETH currently posited of around 2 to 5% per annum, and it depends on the total deposits and number of stakers. The more deposits and stakers there are, the lower your return, so they're using it as a mechanism to incentivize more nodes when there are few. There's a few risks associated with that. So first of all, it's a future thing. It hasn't happened yet, with very uncertain release timing. So if you need something now, then it's not exactly available. I'll grade a few points out, but in the interest of time, I won't talk about them too much. Come find me later if you want to talk about them. Governance risk as well. So in this decentralized world where no one is making decisions, who is making the decisions? That stuff on the left there could change at any time, and we don't know. It's something that you really have to think about when you're investing in this type of thing. How do you quantify it? Good question. The pros here are that there's quite high interest. So if you remember the interest that the incumbent insurance companies have on their assets, that's not too far away from that. There's likely to be sufficient volume as well. It is the main Ethereum chain, so people will be using it. The downsides are that there's a variable return depending on the stakers, as I mentioned, and they currently have posited this 4-month withdrawal period, which means that it's very difficult to withdraw your assets once they're in there. this is in order to determine whether you've acted honestly and whether or not you need to be slashed. So that, yeah, that's not an ideal thing. Some others. So Matt mentioned DAI earlier as a USD stablecoin. What they proposed is once they release multi-collateral DAI, so currently it's just backed by Ether, in the future it'll be backed by more assets. Once you can lock up multi-collateral DAI, you can put it in something called a DAI savings rate contract, which doesn't have any fees or fixed terms other than gas for transactions. And they've said the rate of return will be below the maker CDP stability fee, currently set at 2.5%. So the maker CDP stability fee is basically a term that they use to say, well, this is how much it costs you to borrow DAI from them, and then being a lender will give you a rate below that, i.e. acting like a bank. Risks here, MakerDAO system stability. So it's been very resilient throughout the current market downturn when many people maybe weren't expecting it to be. But the risk remains that something happens to it and the DAI is no longer pegged to the US dollar. Make it quite complicated. Governance risk as well, so this is one of the early experiments in kind of on-chain governance. There's many centralized components as well, but again, compared to institutions such as banks and governments, it's hard to quantify that. The big pros are here that it's liquid, so you can put your money in and take it out as you want. There's reasonable volume, so I think currently about 65 million DAI. So for a young DAO / discretionary mutual, that's not too bad. And there's a link to need space, so that basically means that longer term, if you want to offer products to people who think about things in US dollars, it's quite a good thing that you would be able to earn a return in US dollars. A few others, so Compound.finance, they do decentralized money market pools for ERC20 tokens on-chain. And the rate of return is kind of algorithmic and based on the supply and demand, so there's a big pool of money, you can borrow from it, you can lend to it. The pros, instant liquidity, quite easy to use and understand, big pool of money goes in, money comes out, great stuff. The downsides are currently that there's low and uncertain returns. So I believe on wrapped Ether, you can currently get 0.25% per annum. Also quite low volume currently, but as hopefully this Cambrian explosion of blockchain stuff continues and they really get to become bigger. Dharma Protocol, also mentioned by Matt earlier. So they're a protocol for creating peer-to-peer lending instruments, financial middleware, reliant on end-user applications being built on top. There's some credit risks here kind of linked to meat space again, so they currently have very collateralized loans, but over time they hope to do loans that aren't fully collateralized, but this relies on bootstrapping a system of underwriters, and I think that the Dharma guys will freely admit that that's not yet in place. But it'll be interesting to see where it goes. They actually, over the last couple of days, announced something called Dharma Lever, which is an institutional solution that they're proposing where someone can just specify investment parameters and acquire the kind of loans that the institution would like. And these instruments are tradable, so they're non-fungible tokens representing your interest in the loan, which is great. Again, so currently low volume and complex management process. So I think both Dharma and Compound, who I talked about earlier, suffer a bit from there being a lot of people who want to lend money, but not that many people who want to borrow money on-chain. So to sum up, there's a lot of opportunities and many new possibilities emerging for these types of assets. The competitive returns are possible, which would be comparable to what a traditional insurance company would earn these days. And there's the benefit of having open access to it and automation, so it happens automatically if you hook up your contracts to it. You don't need to ask anyone permission to do it, you just go ahead and do it. The main challenges around it are that it's difficult to find a fixed predictable rate to match to your insurance liabilities. There's non-traditional risks that are tricky to quantify, particularly around governance, and in a lot of cases the products either don't exist yet or the required volumes are not really available. But I personally think it's a very exciting space and definitely one to watch. Thank you very much.
Thank you, Rai. Very, very great presentation, fascinating topic. Do we have any questions from the audience for Rai? If not, then I would just add as a comment that we have also looked at this space and of course are very aware of that. However, we decided to postpone that question because we think it's just too early to even start thinking about it before we have not resolved all the other challenges in that space. So it's great to see that you are actually already working on it, but maybe on the timing. When do you see this making a difference?
Yes, so you're absolutely right, Stefan. It's quite early at the moment, and I think the plan is to launch with just currency assets. Again, like you said, solving all the other challenges. But I think if by the time that Ethereum proof of stake is released, then institutional investors, such as, if you could call a decentralized insurance company that isn't investing in it, I think I'd be quite disappointed.
Thank you so much. Another round of applause for Rai. Thank you.